I've been trading price action for more than 14 years, and in this video I'll show you my 3 most favorite and the most powerful price action concepts that I use in my trading. You can use it on any market, on any time frame, and I'll show you exactly how to find the best entries, where to put your stop loss, how to find the right exit, and how to manage your trade once you're in it. So let's get into it, and the first one is referred to as the triple tap. And as the name suggests, we need 3 taps. What is a tap? A tap is basically just a swing high, and the idea is behind the triple tap is that each following tap is showing more and more weakness. So whereas in the beginning you can see the market was able to easily move higher here, the following taps are always showing a decrease in trend strength. So the distance and the height between each subsequent tap is lower. And this shows us that the ongoing trend here, in this case the uptrend, is weakening. So this can mean 2 things. First, if you're in a long trade, it is maybe time to look for an exit now. And if you are looking for new trending opportunities, now it may be a good idea to start looking for shorts. And this is exactly how we're going to use that. So we are now on the daily time frame, and first of all we have identified the triple tap. We can see that we have some type of channel here, and we could go down to the 1 hour, to the 4 hour, and then look for trading opportunities into the trend direction that we are determining based on the triple tap, which is a short. And on the lower time frame we can very nicely see here that the market is in this channel or this wedge. Let me just draw it a little bit more precisely. So you can see here we have a very nicely fitting trend line. We are also able to identify the last swing low, and the idea is that we are looking for shorts here into the trend direction. So let's see what we have. And we need to wait for a full complete breakout out of the last swing low that we have identified, which we have now. As you can see, the market is completely breaking out of the lows. We have made some pattern that we are going to cover actually in a moment as a second price action signal that I absolutely love. But for now, let's focus on what we are seeing here. We're seeing a short position, a short entry. Stop loss could be here just above the last pattern here, above the last swing high. And for targets, you have a few options. Since we're trading with a new trend, we could really make use of that information and extend our target, because we are now estimating that we are early on in a new trending environment. So we are going with the trend, but also we are very early on, so we could catch theoretically big winning trades. So let's go for this 3.2 reward to risk ratio. It's based on a previous swing low. It's also the origin of this trend line, and let's see what happens. You can see the trade is unfolding nicely. We have here a retest, but that's exactly why we put our stop loss where we put it, right above the highs. We don't want to put it too close to be able to stay in those trades even if we see those short-term volatility spikes. And you can see afterwards the market is unfolding nicely. You can see it's moving lower and lower nicely. It is struggling a bit, but that is totally normal. You will not see that a market is moving to your target in one straight line. Trends always take some time to unfold, and as long as overall the trend structure is not broken, we could hold our trade open. You can see we are coming back, and you can see shortly after the market is reaching the target. So a very nice trade idea. We are starting with a higher time frame. We are able to identify when a previous uptrend is likely to roll over. So this can help us time new trends and new trades very early on the lower time frames. And then we simply just use a breakout approach. You could also use a break and retest approach, totally up to you. But the main idea here is the triple tap for the higher time frame. You could also look for a triple tap on a lower time frame and trade it directly. So what we see here is an overall downtrend. And we can also see that the market, although it is making lower lows, the lows show that the market is losing strength here to the downside. Whereas the initial push here was very far and very deep, suggesting a lot of selling pressure. The next low, first of all, it took much longer, and also the distance is not that great. Here you can see the market just barely pushed lower and was not really able to make a very convincing lower low. So what does it tell us? It tells us, first of all, that the downtrend here is losing strength. So we are looking here at the triple tap. The triple tap is this area here. 3 consecutive lower lows, but each low is showing us a decline in trend strength. And what we can do is apply a very simple break and retest approach. So we have identified the support and resistance level. We could wait for the market to get above it, look for a breakout, either trade a retest. It's a little bit up to you, what you prefer. And then this is how you could approach this right at the lower time frame. So here you can see we have a breakout now above the highs. Stop loss in this case, we could put it above the lows. For targets, we can look left and see where are big support and resistance levels, where is a good level. So you can see we could go here for this high, which is pretty much the origin of this trending phase. So we could use that in our trading. Our target should never be right at the level, but a little bit before it, so that we can account for premature turning points. And let's see what happens. The market is taking off, performing here the retest. If you're a pullback trader, this is exactly where you want to look for a retest. And that is also why we don't put our stop loss too close, so that we can survive such drawdowns, because they are very normal and very natural. Don't happen always, but they do happen often enough so that it makes sense to account for those in a stop loss placement. And you can see this is where we are currently in this price action chart. So this is where the price action is right now. It is halfway towards our target, and you could, for example, decide to trail your stop loss along the way, so that you can lock in some profits and make sure that you're not giving back all of your unrealized profits if the market turns around now. But this is the general idea behind the fake out. You can use it as a higher time frame confluence or trade it right away on the lower time frame. My second favorite price action concept is the concept of deceleration, and it basically means that you're using the higher time frame price action to look for the market fading strength. So what this means, we are here in an uptrend. Very clear, the market has been moving higher quite a bit, and you can see we have 1, 2, 3, 4, 5, 6, 7, 8, 9, around 10 bullish candles in a row, which is, as we can see, very unlikely that you have 10 candles of the same color consecutively. So this already makes a lot of sense to look for signs that the market is slowing down. However, just because the market is moving higher quite a bit, we don't want to short. That would obviously be a very bad idea, and you're going to lose your trading account. So we need a little bit more information, which we have in this case. We have a deceleration candle. So whereas previously you can see the market only showed us very strong in green candles, here we have a pin bar, and the pin bar shows us rejection. You can see the market moved higher quite a bit and then closed right at the open. So this is deceleration. It shows us that the trend strength is losing strength. However, still not good enough. So we want to look for confluence on the left. We zoom out, and we want to make sure that we are trading off support and resistance areas, because those are key levels that the price has had problems with in the past, and this makes it more likely that we're going to see a reaction again. So we are not just trading randomly a deceleration candle, but we're looking for a deceleration where it actually makes sense in the bigger picture. So now you can see we already have a little bit more confluence on our side. We could also see, is this a completed Fibonacci sequence? So we can see we have pattern A, B, C, and this should theoretically end at a Fibonacci sequence. So probably around the 200 level. If you see that the price action is reversing and showing us deceleration at the 200, that makes our trade idea much stronger. So let me change the color, and we have a pattern. You can see we have A, B, C right at the 61, and you can see we are in the middle between 200 and 261. So this shows us a very overextended and overbought market. So it does make a lot of sense to look here for a short. So now we have quite a few confluence factors, but it's still not good enough. Let's go to a lower time frame and see what we have here. And clearly we can identify a pattern. We know this is our higher time frame level. Let's take it off because we know what it is. And we are able to now find some levels here. So we're looking at a head and shoulders pattern. A head and shoulders is a very important pattern. Why is that so? Because it is a trend reversal pattern. It shows us that the market went from making higher highs and higher lows on the left side, from the left shoulder and to the head to the right shoulder, lower highs. This is very important because this is how trends turn. It is not enough though. We need to wait for the market to break out to really show us that we are not only making lower highs, but also lower lows. This is going to be the final piece to the puzzle. We could then even wait for the market to perform a retest, and you can see how we go from shorting just into a big bullish move on the higher time frame to having a completed fib, to having a resistance touch point, a deceleration candle, a head and shoulders, a break, and a retest on the lower time frames. So this is how you can really nicely improve your price action quality and the quality of your trades. And now the hardest part is coming. We need to wait. We need to wait for the market to break out lower, which it is about to do now, but we really want to make sure that the market is showing us a strong momentum candle, because we want to make sure that the market is really moving into our trade direction, which is happening now. So now you can see we have not only one lower high from the head to the right shoulder, but we have consecutive lower highs. So we already have 4 lower highs, which is great. The more context we have in a trade, the better it is. And now we want to find our shorting tool. Stop loss, again, a little bit personal. Do you like the stop loss to be very small, which can boost your reward to risk ratio, or you are playing it a little bit safer? In this context, since we are trading into a large higher time frame move, we could decide to give this a little bit room and then also extend our target, because the idea is that after the big move on the higher time frame, we could also expect a bigger move on the lower time frame. So we can use this support and resistance or supply and demand area, which would give us a pretty decent 2.5 reward to risk ratio. And also at the same time, we are able to give this a lot of room here to unfold. A wide stop loss is always a good idea, because you're not as easily vulnerable to a volatility spike. And let's see what happens. We are moving lower. If you're looking for a pullback, this would have been your clue here. And you can see the market is unfolding nicely. And again, don't be discouraged when you see the market make a small consolidation. It is very normal to see the market move in those waves. The same is happening on the way up. You can see the market is never moving in straight lines. It is always following this back and forth, up and down. And this is exactly what is happening now. So totally normal. You could decide, for example, to throw a moving average on your charts, maybe the 50 EMA. And by the way, you can see the breakout approach happened with also the break of the EMA. You could then decide to trail your stop loss behind the moving average if this is something that you are interested in. And let's see what happens. We're just going to follow the price action and see what happens. The market is retesting the moving average. So having the moving average here gives you a little bit more confidence, because you can see it makes sense to see the moving average being retested here. And as long as the price action is not really breaking above it, we can trade with a lot more confidence. So having a moving average on your chart is never a bad idea. And the 50 EMA or SMA work very nicely. So here you have now 2 choices. Either when the market is breaking the moving average, you're going to close your trade. Maybe it's going to be closed automatically if you have a trailing stop loss. You could also decide to take partial profits, maybe take off a third, half, 2/3, a little bit up to you, and then let the rest run. Again, really personal, but I just give you a few ideas how you could approach it. And then you can see afterwards the market is breaking again above the moving average. So now probably would be a nice idea to fully close the trade, because the market is also breaking into a new high. And this is how you could approach it. You can see the market came very close to your target, didn't make it all the way. But this is the reality of price action trading. It doesn't work 100% all the time. The market can change intraday. And so you need to be able to react with your trading plans. And there are a lot of options that I gave you in this example. Hope you enjoyed it with the deceleration, and let's move on to the next one. If you are a breakout trader, maybe you're also struggling with breakouts, fakeouts are a common issue, then this can really help you improve your trading quality. The third concept about price action is called the lower bounds. And for the lower bounds, we need to first identify a support and resistance level. We can also use a trend line like here. And now we are looking at how is the market trading into this level and to the line. So as you can see previously, the first time the market came into the level, the market moved higher a lot, a very, very big move right into the previous highs. So very strong reaction. Then the next time, what happened? The market came back into the level, and you can see there's already a huge difference, because the market from this high to this high, obviously that's a very, very different story, because first of all, the market wasn't able to rally a lot. And also in a short period of time, the market came back into the level. So you can see the market is back into the level right away. So what does it tell us? It tells us that there's not a lot of buying interest anymore, probably. And the more the sellers are becoming interested in getting into the trade earlier. Whereas previously the sellers needed to wait until the 140 round number. Now the market and the sellers were able to get in and interested at 138.7, so much sooner. This already hints that there's probably more selling pressure building in the market. And let's see what happens afterwards. I can see the market is coming back into the level and reacting again. So let's see what happens this time. First of all, we have another touch point. So from here, the market made a lower low once again, a lower high. So we are not able to break above that, which is indicating that the pressure of the selling side is really building here behind the scenes. So here a lot of selling pressure is now accumulating, which makes a breakout a very interesting trading idea. We don't know if a breakout will happen just because we see the market behave in such a way, and we cannot predict that a breakout may happen before it happens. That's not the point of technical analysis. What we want to do is identify scenarios and then build trading plans around them, so that if the market breaks out of the level and closes here below the trend line, we know that we are looking at a high probability setup that really fits into this overall chart context. That is what we want to do. And then we can trade with full confidence once we see the market is clearing this level. So let's see what happens. And you can see the market breaks out, but very interestingly, before the breakout, we have the ultimate confirmation signal. You can see the market moved into the level, away, into the level, away, into the level, and this time only after 2 candles the market broke out. So whereas previously it took the market a while, and this is already not a strong reaction, now after 2 candles the market is not only back at the level but is also breaking below it. So this is our clue, and now everything fits together. And this is what we have to wait for as breakout traders. We are not going to get in before. We're not trying to predict a breakout before it happens. That would be not a good idea, and you're going to run into a lot of fake outs. We always have to wait for it, but once we know and once we see that the breakout is happening, now we can trade with a lot of confidence. And let's assume we get in here. Stops, again, very simple, keep it above the high, or if you want to be a little bit more aggressive, keep it above the lower bounce. So here's the lower bounce. And for targets, first of all, we could zoom out to see, okay, where does it make sense? And we are here in the overall picture. Here, this level jumps really out. So here is a previous resistance that turned into support. And you can see this would give us a very small target. So maybe this would be a good idea for a first target. We have the second support and resistance level here a little bit lower. You can see this is a break and retest level on the left side, and that could be our second target. So we could approach the trade something like that. For example, scale out, and then the second position is really going to make up for it, 2.5 reward to risk ratio, whereas the first one is just barely giving us a 1-to-1. So let's see what happens. And let's see. Okay, the first one is actually cleared quite easy, but there's a high chance we're going to see some type of reaction, which we're actually getting. But you can see the market is never pulling back into the trend line, let alone above the high. So this is never threatening our trading idea. We are making a retest here now on the last low. We are retesting it. Staying below it is a very good confluence, and you can see the market is moving into it. Just out of curiosity, is the market able to break below it, or is this level holding? And you can see we are struggling, but the market is coming back into it. And is this giving us another lower bounce? Let's see. So here we could actually see another lower bounce. So a breakout below that would be a really interesting trading concept and a trading context rather. And you can see we're not breaking below it. The market is struggling. And you really want to make sure that you are seeing a move lower. And we don't get that. You can see the market is pulling away. So that is why we need to wait for a breakout. Otherwise, you would have run into a fake out, and that is obviously not a great thing to be in. So you can see the market never cleared the lows. We never had a full breakout, and that is why it's so important to always wait for the market to fully close beyond the level that you identified for your breakout.